In this example, we are going to learn how to model interest cost and loans and debt. In this case, because the company also has foreign currency loan, we shall also see how to take care of foreign exchange rate changes in our financial models. While building financial models, sometimes it becomes important to reconcile the data in financial statement with the numbers provided elsewhere. For instance, the notes to accounts. In this case, for instance, if you look at the problem mentions that the company has a local currency term loan of 120 crores. However, when we look into the balance sheet, we notice that the company has only 96 crores of local currency loan as part of their long-term debt. And as such, there is a difference of 24 crores. But we would find the same 24 crores included in current liability as current portion of long-term debt. So that amount explains the difference between the long-term loan we see in the balance sheet versus what we saw in the notes to accounts. Such reconciliations are very important wherever it occurs in order to build a robust financial model. So let us start with interest cost. Now we know that interest cost is levied as a percentage on the loans outstanding. So we may be able to define interest expense as average loan balance multiplied by the interest rate. The next question is, how do we calculate average loan balance? One way to calculate average loan balance is to define average loan balance as opening balance of loan plus closing balance of loan divided by 2. But this definition has a problem. And the problem is that while interest is dependent on average loan balance, which is in turn dependent on closing balance of loan, closing balance is arrived after adding interest charged and reducing the interest paid. So interest is dependent on closing balance and closing balance is dependent on interest, and this creates what we call as circular reference. So what's the workaround? As we had discussed in an earlier module, instead of calculating average loan balance as opening balance plus closing balance by 2, we can calculate average loan balance as opening balance plus 1 by 2 of net borrowing. You would notice that this is similar to what we did for depreciation. This would assume that the company pays interest on time and therefore the closing balance is not dependent on the interest that's being charged. That is a simplified assumption just to avoid the problem of circular reference. However, in certain cases where such simplification is not desired, we may have to live with circular reference, for which we may have to enable the iterations in Excel options. So with this understanding, let us develop a loan schedule, or what we call as the debt schedule. Building a loan schedule or debt schedule is not very straightforward. The reason being, the company has 4 different types of loans with 4 different repayment options as well as different interest rates. For instance, the company has a bank overdraft of 25.2 crores which carries an interest rate of 13.5%. Now typically bank overdrafts are working capital loans where a repayment is not necessarily mandated. These are running accounts where monies flow in and out on a regular basis and just the interests are charged and have to be serviced on due date. Next, what we have is a term loan which is repayable in 5 equal installments, and moreover it has an interest which is dependent on the bank's prime lending rate or LIBOR. We would call these as the floating rate loans. LIBOR is what are the benchmarks in the Western world. In India, it is the BPLR, what we call it as. We have the third loan, which is a foreign currency loan with fixed interest rates and a bullet settlement. A bullet settlement is one where the repayment is made on the last date of the loan tenure. Another challenge in foreign currency loan is that while the loan is denominated in foreign currency, the books of accounts are always stated in the functional currency or the reporting currency of the company. Finally, we also have one more loan which the company intends to take. Here the interest is fixed, but the repayment is on an equated annual installment basis. The difference in this case is that the amount that's repaid includes principal as well as interest, and the total repayment installment per installment remains same across the tenure of the loan. So here calculating the equated nominal installment becomes a tricky part. So essentially what these variations require us to do is to build a debt schedule with separate schedules for each of the loan, which will then have to be summarized elsewhere. So let us go ahead and capture these information and try to build a financial model with, specifically the debt schedule. So we have set up a debt schedule with separate placeholders for each of the different loans that the company has. So let us start building the loan. Now, short-term loan, as far as short-term loan is concerned, we discussed that the company does not have an obligation to repay the fixed installment on an annual basis. The amounts are deposited and withdrawn on a regular basis. So here, rather than building a detailed model, what we would assume is average loan balance for the company. Now, the average loan balance for the company in 2012, if we have to take the year ending balance, that was 25.2 crores. So let us capture that amount in our model. The problem mentions that the company is expected to roll over the loans in future. So which means we shall assume the same amount as outstanding for 2013 as well. Yet this is an assumption, so we shall highlight it in the respective color code. Now a question that naturally arises is, why are we keeping the loan amount directly punched in the debt schedule rather than keeping it in the assumption sheet? The explanation is, while we would like to keep all the critical assumptions in the assumption sheet, certain numbers are better left off in the main schedule where they are worked out. The reason being, while the loan balance amounts have less certainty in them, in the sense the amount of repayment is kind of predetermined, the analyst would also want to know what happens to the loan opening balance and closing balance as he changes the figure. Now, if we have these numbers in the assumption sheet, it might be a little difficult for an analyst to find out the impact of the changes he is making on the opening and closing balances of the loan. On the other hand, as we discussed, this is neither a critical assumption with a lot of uncertainty, as the amount that a company is repaying is kind of known already. But having said that, the interest calculations do have an uncertainty in them. For instance, if the company's credit situation worsens over a period of time, the interest that the company pays might have to go up. For this reason, we shall capture interest rates in the assumption sheet. So we have average loan balance here. If we have to calculate interest on the loan, we also need what interest rate. The interest as provided the problem is 13.5%, so we are capturing it here. Given that this is a fixed interest rate which is not expected to change, we may also be inclined to include it as part of non-time series assumptions. But however, as I said earlier, over a period of time, if the company's finance, the interest rate might undergo a change, and that's the reason we may prefer to keep it as part of the time series assumptions. Now let's go to the debt schedule. So here we shall link the interest rate to our assumption sheet, and we shall calculate interest on loan as average loan. In this case, we can as well take average because there is no repayment involved and interest does not affect the outcome. Average loan multiplied by the interest rate. The next thing we'll do is to build a model for local currency term loan 1. So term loans have, for which we need to have a walkthrough, because we saw the equation for closing balance already, which is opening balance plus loans borrowed minus loans repaid. Capture each of those components here. First is the opening balance, then amount borrowed, then amount repaid, and finally we have closing balance. Now closing balance for a year, we can get it from the balance sheet, for 2012. So we'll link it to the balance sheet. So you can say it's 96 crores of local currency loan in long-term debt and 24 crores of short-term debt. Enter. While 120 crores is the number we would like to work with, we may also have to capture the amount of short short-term portion that's sitting in this. That is required for modeling the balance sheet. So let us capture one more term here, of which current portion of long-term debt. Now sometimes we would like to have these subgroup or breakups a little indented. So the best practice would be, rather than to use the space bars to indent them, we shall use the increase indent button on top to indent them. And in here we know the current portion is 24 crores, which is again included in the balance sheet. So we'll link it to that. Now opening balance of any year is going to be the closing balance of the previous year, so we can simply link it to that. The amount borrowed and repaid are pretty much the assumptions. So amount borrowed, we're going to assume 0. The amount repaid is, it has to be repaid in 5 equal installments, so we are going to have 120 divided by 5, which is 24 crores. Or the other way to look at it is, the amount that has to be repaid over a period of 1 year is going to be what is classified as current portion of long-term debt in the previous year. So we may as well link it to the current portion of long-term debt in the previous year, in which case the amount is not an assumption, so we'll remove that. So closing balance is going to be opening balance plus amount borrowed less repayment. Now if we need to extend the model, we would also need to know the current portion of long-term debt. So in here we are going to say the amount repayable is 120 divided by 5, which is 24 million. This is an assumption, so we would highlight it. Now when we extend the forecast, it may so happen that the company after a period of 5 years has repaid the loan, but this 24 is going to remain as 24 as it is. In order to avoid that, what we can use is to use the Excel's min function. So we are going to say the amount that will be in current portion of long-term debt is either going to be a minimum of 120 divided by 5, that's 24 million, or it is going to be whatever is the amount sitting in the closing balance, whichever is lower. So if the company has a closing balance of 2 million, obviously we cannot say 24 million is the current portion. So we'll link it to that. The next aspect is to calculate interest on this loan. The interest rate on this loan is slightly tricky because, as defined in the problem, it has two components, namely the BPLR and the spread over and above the BPLR of 4.5%. The spread again may change, increase or decrease as the company's credit situation worsens over a period of time. But this being a term loan, such a restatement might not be possible because it may happen for a short-term loan but not for a term loan. So while the spread might not change, the BPLR might change. So we may want to keep the spread as a non-time series assumption and the BPLR as a time series assumption, but for the sake of convenience, even if we assume or show the spread also as part of the same time series assumption, it's not a major crime either. Let's capture these numbers in our assumption sheet. So we have these two components. The BPLR is 10.2% and the spread is 4.5%. Let's go back to the debt. So the interest on this loan is going to be BPLR plus spread on the BPLR, which is 15.7 or rather 14.7%. Now in this case, because we assume that the interests are repaid on time and we did not let interest affect the closing balance, we may as well calculate the interest as opening balance plus closing balance divided by 2 multiplied by the interest rate, which gives us the interest of 15.9 crores on this particular loan. We would have got the same answer even if we had opted for the other formula, which is opening balance plus 1 by 2 of the repayment multiplied by interest rate, which is the same 15.9. When you do not assume interest to affect your closing balance, both of the formula works fine without creating problem of circular reference. If this is clear, let's move on to the local currency term loan 2. The one problem with the term loan 2 is that the company does not pay interest separately. It pays an equated installment which includes both principal and interest together. So while we have so far laid out the equation for closing balance as opening balance plus amount borrowed minus amount repaid, in case of term loan 2, we also need to make two other adjustments. The first one being interest charged, and the second one being interest repaid. So we would add the interest charged and reduce the interest repaid portion to arrive at our closing balance. Now this term loan was not there in the balance sheet because it's a new term loan. So we'll capture most of the information here in the debt schedule for the first time. So opening balance was 0 and amount borrowed expected to be borrowed is 45 crores. The current portion of long-term debt, again we'll come to it in a second. First let's calculate interest on this loan. So we'll have to capture the interest rate in our assumption sheet. Now this loan has a fixed interest rate, so we may as well keep it in non-time series assumption as this is not going to change over a period of time. Interest rate on term loan 2, we know that is 15%, so let's capture that. Let's go back to the debt schedule. We're going to say interest rate is in the fixed asset schedule, the assumption schedule, 15%. Now interest that's charged on the loan, it's going to be opening balance plus 1/2 of the loans borrowed. Now in order to avoid circular reference, we are not calculating it as opening plus closing by 2 as discussed earlier. Also we are excluding repayment in this case because typically the repayment may happen at the end of the year. But in case if we assume that the repayment happens at some time in the middle of the year, so we'll also add 1/2 of that because for half of the year the repayment would have been there. So we have it here. Before we leave this schedule, we have so far been working only on the assumptions for 2013, but just to understand how to handle this particular situation, let's first look into 2014. How is the forecast going to look like? So the closing balance is going to be 45 crores. We'll have it there. The amount to be in 2014 is nil. The amount that will be repaid, which is where the formula comes into picture, it's going to be, we are going to use a payment function. So we're going to say equal to PMT. That's the payment function. What is the amount the company would borrow? Open the bracket. First we'll mention the interest rates. The interest rate is there in our assumption sheet, so we'll link it to that, comma, we'll go back to our debt schedule. The next is what is the loan schedule? What's the loan repayment tenure? Now we don't have this tenure yet, so we'll have to capture that. Let's capture that in our model, in our assumption sheet. So the loan repayment tenure is 5 years. We have captured that. So the next step is number of years. Since we have already captured it, we'll link it to our assumption sheet, comma, go back to the debt schedule. The present value is what is the principal value that the company needs to repay at the time of calculating the equated installment, or the annuity, what we call as. So we'll link it to this 45 crores which the company needs to repay, and at the end of the repayment tenure, because we do not want anything there, so we'll skip these parts, future value and type. So we'll close the formula here. So this formula gives us an answer that the company has to repay 13.42 crores over a period of 5 years. So closing balance, we'll copy the formula. Now the interest rate, we can as well link it to the same number forever, or as such we'll freeze the formula reference to D7 because it's a non-time series assumption, and we can copy paste it. So the interest in this case that the company is going to pay is 5.7 crores. So what we'll do is, in both the years we'll add the interest on loan to our debt schedule, so that adjusts the company's loan here. So we have the schedule built out all the way up to 2014. Now here again few more adjustments are required. What is that? As we extend the formula, we may encounter a situation where the company only has 6 months of loan to repay because the repayments are happening at the middle of a year. So this 13.42 might be more than what the company actually owes the bank. So to overcome that, what we can do is, the amount repayable by the company is either minimum of the amount that needs to be paid by the company, comma, the sum of opening balance plus borrowal plus interest, because if the 3 is less than what the amount actually owed by the company it's enough if the company pays the net of opening balance and interest. Typically in a term loan, the company is not going to borrow any new loan in between a year, so you may as well exclude it, but just for the sake of consistency we are retaining it in this particular model. But that creates a circular reference because the interest charge is dependent on amount repaid and amount repaid is dependent on interest charge. The way to overcome that would be either to compromise on the interest formula or simply exclude the opening balance, or rather the interest component, from the minimum calculation. But the even simpler approach is actually to simplify the interest calculation, where we exclude the dependence of interest on the repayment. So what we're going to do is, in our interest calculation, rather than adjusting the repayment, we will not adjust it and leave it as it is, where we are assuming that the interest is applied on the opening balance. Now it does affect the overall result of our calculation, and we are settling for a compromise formula here, and it's not an optimal formula, but it may sometimes be necessary to go for compromises in the formula if you want to avoid circular reference. There is nothing wrong in going with a circular reference, but going with a circular reference might affect certain other parts of your model, so we sometimes compromise on the formula if the overall impact of that on our model is not significant. So we made slight compromise which has ensured that our model does not have any circular reference as such. Now we have one more component left, which is current portion of long-term debt. How do we compute it? One way to compute it would be to link it to your repayment of next year plus the interest charged. But the perils of keeping it this way is that in the last year of a forecast, so for instance if I go to 2014, I would notice that the current portion of long-term debt comes out as 0. This is a problem in case if the loan repayment exceeds the forecast period, but if it does not exceed the forecast period, we may as well have the current portion of long-term debt linked to the amount to be repaid next year net of the interest that will be charged. So that shows the principal component the company has to repay. In this particular case, we may settle for this particular formula because we would be forecasting all the way up to 2020, whereas this loan, given that it has a loan repayment of only 5 years, will be repaid by 2018 itself, or at the max 2019 if there are any leftover components. In case it is not suitable, where you have to extend it all the way up to 2020, there's one more way to handle this, and that is to show all the calculations that we just did in 2014 column in 2013 column itself and linking it back to 2014. For example, I'm going to have this equity installment and interest for next year column here. So the equity installment, we'll copy it from what we just have and paste it over here. in 2013 column, and the interest calculation which we have in the interest on loan section, we'll copy it and paste it over here in 2013 column. We may then link the interest to 2013 and repayment as well to the previous year in the sense, and this calculation will ensure that even if your loan repayment exceeds that particular tenure, our calculations will sound appropriate.